Right, so welcome everyone to this week's group call. It is Wednesday, the 1st of April. Hope you're all doing well. And I guess the first maybe 15 minutes of this week's group call is going to be spent just kind of welcoming the new traders within the group and just really kind of going over what Trading 180 really is about before I get into any of the analysis. So yeah, just again, a warm welcome to all of the new traders that have joined this week. And really, I know, obviously traders will come from have different experiences, different approaches. Been out in the social media wilderness as to, how to trade. And there's many different ways to trade. I'm not saying that mine is the unique way to be successful in trading. There's hundreds of ways, but for every probably one way who's, a successful way of trading, there is probably, thousands of just random ways, right? Who knows the statistics or the data? But basically, I'm just going to go over my way of trading. And so the goal really is I look to identify value, right? So we're looking at discounts and premiums using a combination of fundamental risk sentiment and technical analysis, and we're going long or short the rumor and confirm with the data. So what we're trying to do is we're always constantly trying to look for the rumor, right? And the rumor is like basically like a bit of a trade idea, which is backed up by data. So let's say, for example, the data suggests that a central bank may hike or cut rates, right? We will then look to go long or short on that rumor, but then look for continuing data to confirm that rumor, right? So let's say inflation is starting to come down, right? And then we get maybe, central banks or some analysts, market analysts that's talking about they could potentially look to cut rates, right? Because inflation is coming down. Fine. It's just a rumor. We can't, the rumors can start out of thin air. But what's going to give that rumor any kind of credibility is if, inflation measures continue to drop and fall maybe below that 2%, inflation target that central banks have, a bit of overshoot of that 2%. Then as the data supports the narrative, the data supports the rumor, we're looking to, of course, get involved in that, right? So that's really where it comes from. Because I know I got a question, which was, I think it was something kind of related to that with regards to kind of waiting for the data to kind of appear. And one of the things that you'll notice is that I very rarely look to trade the news in terms of sitting here by the computer to trade the news. Robin's been with me for a while, and he knows that we're already in trades usually. When I'm looking to trade anyway, I'm trying to get ahead of the news. And if the data comes out and it supports my trade, then brilliant. If it doesn't and it goes the other way, then I'll look to come out of that trade or maybe hold, depending on, of course, the trade. And Robin says, I love the way we are taught to trade here in Trading 180. I'm going full-time member next payment. Oh, excellent. Well, yeah, I look forward to that. Right, 1 second. Right, letting someone else in. Yeah, so like I said, Robin's been here for a while, and it's like I said, it's very fundamentally driven, right? It's fundamentals for the direction, and technicals really just for the timing and the entry. That's really what we're looking for. So we've kind of our focus is on divergences in interest rates. So interest rates are really one of the main drivers of currency value, right? And price as well and value are two different things, but really we're kind of focusing on interest rate differentials, right? Divergences or leading and lagging interest rates, and really what moves interest rates are really two, maybe three key things are, inflation and GDP, really, and, the business and the economic cycle, right? And as well as risk sentiment as well. So you've got inflation, GDP and risk sentiment. And risk sentiment, for example, the one that we're in right now, with regards to the Middle East conflict, you can see how, I don't know if many traders have been with me for a while, but you see, if you have, you'll notice that you'll get maybe a headline that suggests that, of course, the conflict is escalating, right? And what that is doing. And I will go over this a bit later as well. And I know many of you may not understand this right now, but risk sentiment can kind of just affect the overall inflation and GDP, right? And so the longer this Middle East conflict continues and escalates, is the more that inflation is going to be affected, as well as GDP, right? But which is the bigger threat? And depending on the central bank, they will decide which is the bigger threat: rising inflation or the economy. And depending on which one they prioritize will depend upon which one you may want to buy or look to sell, right? But risk sentiment and risk events can also basically drive inflation and the economy and the business cycle, which then again all leads back to what central banks are likely to do with interest rates. But risk sentiment also as well has another dynamic, which is really less about interest rates and more about safe haven plays and really kind of protecting investors' money rather than looking for a return. But that's literally the focus as to how we kind of derive our direction. And it's not required to know everything about everything, right? I've been doing this many years, and every now and then I'll get questions about some in-depth fundamental nuance, right? We're not economists here. Yeah, our job is not really to kind of forecast, look at all the data and try to, calculate. I mean, you could do it if you want, all the data if you want, but I'm not an economist and I'm not trying to be, right? I'm looking for the overall kind of the macro, the bigger picture, looking at the cycles, right? You'll find that when inflation is rising or falling, it normally does it in more of a cycle, right? Same thing with jobs and a lot of, economic indicators that we look at, right? There's a cycle there involved. So I'm not hung up on the micro side of things, and it's best not to be. It's best to kind of look at the overall, the bigger picture, kind of zoom out and look at really what's important, what's really important, not there's 100 different indicators that you could look towards and try to analyze and see how it fits into, whether it moves currencies or not. There are several things, maybe about 10 or 11 things that I think that end up, driving currencies. Some analysts may say more, analysts may say a bit less, but those are found on the fundamental analysis spreadsheet, right? Which, if you haven't got access to it yet, just send me a DM and I'll with your email, and I'll add you to this, right? So you've got, for example, GDP, quarter on quarter, year on year, interest rates, real interest rates, inflation, and a few other things. And then we give them all a ranking. And from here, we can kind of see, gives us a bit of a snapshot as to, from a fundamental perspective, purely based on data, which currencies should be the strongest, which should be the weakest. Of course, it's not always like that because there are other factors, but generally this is what you're starting off with, right? As you get deeper into the fundamentals, you'll understand that there are definitely a bit more nuances with regards to just looking at the numbers. But going back to, it's not required to know everything about everything. You can go down a rabbit hole with fundamental analysis. I just suggest that you kind of stick to and kind of master what I show you in the group. And direction confluences, right? What we're looking for is, once we've decided on a bias, and that bias will be driven really by, central bank statements, right? And comments, whether they're hawkish or dovish. Government bond yields we use because we understand that government bonds, bond traders are highly sensitive to interest rates in the economy and inflation, really. So bonds can also be, used as a confluence with trading currencies and Forex. bank forecasts we use in analysis, of course. COT data. Many of you look towards COT to confirm. And actually, in fact, I've been kind of behind the scenes working with a trader. For years, I've kind of been on and off COT. I haven't really needed it or used it, at all with my analysis. But again, it was sparked by a DM that I got maybe about 3-4 weeks ago, probably somewhere in that region. And it was to do with, he was asking about COT. And I ended up down a little bit of a rabbit hole with COT with open interest, and looking at open interest. And I found something which I think it's not a leading indicator, definitely not a leading indicator, but it's something that will add confirmation for traders who maybe want that confirmation, because of course relying on your own analysis can be tough, right? Because ultimately we're trying to follow the banks, right? But if you do fundamental analysis properly, you'll be on the right side of the banks more often than not in terms of direction. I'm not saying that you're going to be on the right side, when you're timing of your trades all the time. That's, impossible. But if you understand interest rates, inflation, GDP, you'll be on the right side regardless, which is the reason why I've never really kind of looked at and cared for COT. So the only reason why I'm not going to introduce it just yet. I'm going to probably maybe introduce it over the next maybe couple of weeks. And it's really just going to be more of a screenshot, because the trader that kind of helped me gather this data and kind of compile this data in the way that I like and that I found interesting, he may probably not going to want to, get any kind of emails or DMs and questions as to why. So I'm going to check with that trader first, if it's okay to kind of share maybe some screenshots from what he's built, and then I'll get the okay maybe from him, and then I will share. And what the whole point in just revealing open interest and the way that I look at open interest, and what he's compiled for me, is more to maybe add a bit of confidence to your trading, and kind of knowing which that the non-commercials, I guess the hedge funds are looking at in the same direction as us, right? That's all it's really about. Because as we know, COT, when it gets released, it's really kind of lagging in terms of confirmation. But it doesn't really matter too much when you're looking at the medium to long term. If you're looking at, day trading and trying to get in and out, then COT, I think, may be, less useful. But if you're looking at more, fundamental trading in the way that we do, and I guess if you want to call it swing trading and kind of holding, then of course it doesn't really matter too much. But again, I'll get into that a little bit, maybe the next couple of weeks. And of course, you've got things like seasonality as well. So identifying value from daily, weekly chart timeframe perspectives, right? And so again, I've got a bit of a question earlier today. I can't remember if it was from you, Narian. I'm not too sure. It was from someone about following trends from price and things like that. And ultimately, a price chart is just that. I mean, I know traders will look at a price chart and say we're heading higher, so we're bullish, and if we're heading lower, we're bearish, right? But again, that's very subjective, right? Because depending on the time frame you're looking at, and depending on how much data you have on your chart, you can make an argument for whether a chart is bullish or bearish, right? I'll give an example of that. Let's give an example of that, right? So you can give an example. You could say, all right, well, what am I on, the pound dollar, right? We could say, are we bullish or bearish? Clearly, we're bullish, right? Trending higher, right? This is just a 1-day chart. Now, are we bullish or bearish? Potentially, bullish and bearish, right? Where do you actually get bullish on this chart? This is a 5-day chart, 5-minute time frame, right? Every candle's time frame, right? So you're kind of in between. then do you look at this chart? Are we bullish or bearish? Some people would say maybe bearish because we made a new low. Some people might say a bit bullish, right? Because we're moving up to the upside. Who knows? Again, looking at the 3-month time frame, is that bullish or bearish? Okay, that's probably more bearish. It's a bit more clearer. Looking at the 6-month, is that bullish or bearish? Again, it's subjective, very subjective. Whereas if you understand fundamentals, it becomes less subjective. You're less drawn in by what price is doing and understanding really more of the value side of things, right? Whether something is at a discount, whether something's expensive, an exchange rate is expensive, and vice versa. So that's really what we're looking at. But we look at the daily and the weekly time frame perspectives in terms of identifying supply and demand. So we look at higher highs, lows, higher highs, higher lows, lower highs, lower lows. We're looking at auctions or ranging markets of about maybe 150 pips, plus auctions ranges that can be a little lower depending on volatility. And if volatility dries up, that could be a little lower. But on average, we're looking at 150 pip pullbacks before we look for maybe some trades, and of course chart time horizon. So 1 month, 3 month, year to date, right? 1 year on if you're using TradingView, and that's what I was using here, right? With regards to, sorry, not there, with regards to here down at these lows, the bottom left hand side of the chart where you've got sorry, 1 second, don't know if you can see somewhere around here where I do look at monthly highs, quarterly highs, and yearly highs as well, right? In the analysis. So that's really where we are. And that's what I'm looking at. Technical strategies, of course, we're looking at supply and demand zones with, RSIs, some trendline breaks, stop hunts and CPRs in alignment with currency index confluence. And so again, work your way down through the course, right? It's really important that you do work your way down through the course, starting from number 1, right? Supply and demand. And again, you may have come here and you've got your own technical strategy, right? That's fine as well. But one of the things I will say is that please don't ask me about your technical strategy, because I don't know. I mean, I know technical analysis, been doing this for quite a long time, but if you're trying to ask me about, entries from a strategy that you've come in with, I can't tell you, right? I've got my own technical analysis strategy. And so please don't ask me anything about your own technical analysis strategy. So ask me about mine, that's fine. But if you go through it, you'll see supply and demand, right? You'll see capture pain relief, you'll see stop hunts as well. So those are really the 3 main strategies that I look to trade. And of course, you've got the fundamental analysis right here as well, the webinars and the content there. But those are really the technical strategies that I'm looking at. Supply and demand zones, stop hunts and CPRs in alignment with currency index confluence. So currency index confluence is looking at this, for example, where you've got the equally weighted indexes. And by the way, this information is found here. I think it is, 1 second. Currency indexes, number 8, right? Currency equally weighted. There's videos in there which basically go over what my main confluence is. So whenever I'm taking a trade on a currency pair, what I really want to see as well is I want to see the currency that I'm buying actually cheap, and the currency that I'm selling on the expensive side, right? That's really the confluence. But again, as you go through the course and when you watch, my videos, and even later on in this video, I'll show you obviously trade setups that I've taken and what I'm looking at as well, so you get an understanding and an idea. And by the way as well, I definitely highly advise you guys, if you haven't already, if you're looking to understand fundamentals, this is one of the latest fundamental analysis courses that I've done, a bit of an update, and that is found in the fundamental section. And outside of this, I really can't see anything more that you really need to know about fundamental analysis, right? There's always things to learn, of course, but mastering this is enough. But yeah, there's a channel dedicated to this. I think there's about maybe about 16, 17 videos, something like that. And yeah, we go through a lot. It says 14 here, but there's some bonus material as well. I think about 3 or 4 more videos also with that. So there's that. Right. So risk management, I would definitely say 1% max per trade divided up into multiple positions. And no, if you lose a trade, but fundamental sentiment have not changed, go again and again, right? And that's what happened to me, matter of fact. It's very rare that I lose 3 trades in a row, which is basically what's happened to me. On the same pair, right? Not necessarily in a row, just period. But yeah, lost 3 trades in a row on the same pair, but I'm still in. Actually, I've got in on a 4th time. So, and I'll go over that a little later, and that's on the euro Australian dollar. Bit of a strange one, but I'm still gonna continue shorting that. So let's see what happens. 1 second. So Narian says process fundamental technical. Yeah, that's what I'm doing now. Yeah, of course, I'm doing that now, Narian. Right. So so yeah, because ultimately what we're looking for, right, or what you're looking to do is just understand really that, let's say, for example, you're in a trade, right? And let's say, none of us know at a level, for sure, no one knows where, hundreds of thousands of, banks, right, across the world are going to all agree whether there is enough, supply to go short, right? We don't know which level. It could be that level. It could be this level here, right? Trading is about probabilities and statistics over the long term, right? So it's okay if this level, right, you do your analysis and everything ticks the box. You can have a great, you can have the perfect trade, and everything can line up, and you can lose. And you can have a nonsense trade where it's just random. You just basically bought or sold at a level with no analysis, and it can win, right? There's no rhyme or reason, right, to it. It's just a case of, if you're looking at trading over of course, the long term, and you're looking at the numbers, the more, analysis you do, and in terms of you take the right trades, that should play out over the medium to long term. In the short term, of course, any random trade can win or lose. But ultimately, what we're looking to do is just, if the fundamentals and risk sentiment are saying to go short, yeah, and let's say the market doesn't agree that level is, price doesn't reverse down there, right, and it goes up to another level and you lose a trade. All right, cool, no worries. I'll take the next level, right? And if prices come up here and again, I lose a trade, okay, no problem. I'll take the next level. I'm not going to start going long if the fundamentals and risk sentiment are still telling me to go short, because ultimately, that's what I'm going to do. I'm going to follow the fundamentals and risk sentiment. And also what this does is that the higher this goes or against my position, and if I'm right about this, eventually I can get a move to the downside, which then turns into, a 4, 5, 6, 7 to 1, 8 to 1 type trades. And then that will offset any kind of losses that I have, if I'm right about, the trade idea, right? That's really how it goes, or how I trade, because I remember the days years ago where, just following price action, what would happen is, everyone does this, right? You're trying to go long, right? You go here against a level of resistance, turn support, and then all of a sudden it fails. And then you start to go short here because that one fell, and then it ends up going higher, right? And then you start to go short, breakout trade, and all of a sudden now it's not the time, and then you're thinking to yourself, okay, which way should I go? Is it made higher highs? It breaks out above here, so you're waiting for a pullback, and then you're like, okay, I'm going to get long here. And all of a sudden, you place your stop behind there, and then it goes against you again, and you just keep getting tagged, right? I'm sure many of us have been through situations like that, especially on them lower time frames. to me, doesn't make any sense doing that. Be patient. We take around maybe, two trades, 1, 2 trades, depending on if we're lucky, maybe three. And I'll say lucky, it's more about quality over quantity. It's not about quantity of trades, maybe 1, 2 trades a week, good trades. And so that's really what I'm looking for. With the trades, but just because I take less trades than maybe another trade doesn't mean, you make any less money, right? Not at all, because some traders can take 1,000 trades in a day and lose, right? Some traders can take one trade in a month and win. So again, the amount of trades you take does not equate to the amount of money you will make. And lastly, just take your time, right? Take your time. You're here for the next 3 months. And so, just work hard, ask me questions in the group. It's best if also as well, I know I say, you can DM me, but I think it's best to kind of probably ask me or ask the questions in the group. Reason being is because some other people might have, or other traders may want to ask the same question, or they may want to know the answer to the question. They may not have thought of the question that you've asked, but they might be interested in it. So if you ask it in the discussion room in a public, place, then of course I can answer it and everybody can see my answer as well. So definitely feel free to ask me questions in the discussion room. But if you do, you don't feel comfortable in the discussion room just yet, there's no such thing as a stupid question, by the way. The group is very supportive, and they won't, they're not going to, bite you or nothing like that or look down on you. Everyone's, trading at their own pace. So don't feel any, threatened or anything like that, or feel that you can't say or speak or anything like that. We are a supportive group, and we'll try and get back to you. If I can't get back to you, someone else will. So yeah, that's basically it, right? That's basically the overview of trading. 180. Robin says here on AUD, we didn't get stopped out yesterday. Do you know what? You know what? I got stopped out of that one, and it literally stopped me out to the pip, Robin. I placed my stop loss right where it reversed. I think it was something like 42 pips, 43 pips, and it literally price went 42, 43 pips, and it was literally on the nose. Yeah, it was on the nose. I couldn't believe it. It probably was like spread was what kind of got me. And then and then it reversed, right? And then I would have been in the same boat as you in terms of banking some positions on that position. But yeah, I ended up getting back in on that Euro Aussie. So I'm not going to give up on it just yet. So yeah. Let's go into the analysis now, right? So the analysis really is understanding risk sentiment and what's going on, right? So risk sentiment is really based on risk on and risk off. Risk on is when traders are looking for a yield, a return on investment. And so there are strategies for that. And if we're in a risk off environment, then there are strategies for that, right? So from a basic perspective, risk on and risk off is more to do with whether traders want to put more risk on the table, want to put their money in higher yielding assets, and risk off is where they're looking for safe haven. They're looking to protect their assets, looking to protect the value of their investment, and their money will kind of shift into different assets. And in Forex, we there are safe haven currencies, right? Typically, historically, you would know them as the Japanese yen, the Swiss franc, and the dollar. Now, they don't always act as a safe haven, currency. It depends on the risk sentiment and the reasons why they're acting as a safe haven currency. But typically, those are the three currencies that will act as a risk off currency. So in a risk off environment, you should get at least one or two of those currencies appreciate. And during this Middle East conflict, the dollar has been really the safe haven of choice. The Swiss franc has been kind of second, and the yen has definitely lagged behind. So it's important to look at the VIX, right? The volatility index, the VIX, and so the VIX above the 20 is an indication that risk is more off and below is a indication that risk is more on. And the VIX is also, again, a volatility index. It measures volatility. And so volatility is really, price movements. You could get, larger price movements than usual during risk-off environments, right? And so ultimately, this is just confirmation or at least an indication that risk is off. But also at the same time, you want to look at the S&P to kind of confirm that risk is off. And usually in a risk off environment, the S&P and indices, stock indices in general, will usually sell off, right? The VIX and the S&P will typically move inversely, right? So when there's risk on, the VIX will move down, and then the S&P will typically move higher, right? So if I zoom out a little bit, you might be able to see it. You should be able to see it. Let's do a period, right? So if we're looking at this period here where we've gone from risk off, say 20, so that was maybe the February, right, all the way to the upside, you'll see that at the same time, you've seen the S&P go all the way to the downside, right? So that's really what you'll see. And when you see these sharp spikes above the 20, right, to like 25, what you'll notice at the same time is that the S&P's, tends to go to the downside, right? So as the VIX is going higher, S&P's going down. Same thing here, right? That period there, October the 13th to the upside, you had this move to the downside on the S&P. So just because the S&P is going down doesn't mean we're on a risk off environment. You need to confirm that with the VIX and vice versa. And then, of course, you have gold. Now, gold can move, in risk on and risk off environments, depending on, the fundamentals. It's normally a risk off asset, but sometimes it can act as a risk on asset, right? And against the dollar, really, mainly inverse against the dollar. So gold for me should be really just a long-term buy and a long-term investment strategy anyway, as gold is a hedge against inflation. And remember that central banks have a 2% inflation target. So ultimately, in 5 years, if they maintain their target at 2%, currencies are being devalued at 10%, right? Your currency is purchasing 10% less. So, if that's the strategy, gold being a hedge against inflation, should really be a buy. And then you've got the 2-year Treasury yield, which ultimately is a reflection. Bond yields is a reflection of interest rates, inflation, and GDP. Not to necessarily go into it too much, but just and by the way, we do have a channel on bonds as well. Sorry, 1 second, that one. So everything I'm talking about is in the trade. So government bond education right here. Number 20, that will explain, and also as well that fundamental channel. I've got to renumber these, by the way. Apologies, I kind of plonked it in there. That channel I meant to redo these last channels, but also as well the fundamental analysis correlations as well. Channel will go over bonds and their correlation to forex and. But ultimately, what we're looking for is you can use this as confirmation as to what traders are thinking. And bond traders are thinking about interest rates, inflation, and GDP, depending on the direction of yields. And again, the longer you stay with us, with me, is the more that you'll start to see that. And in fact, again, going over when we look at the economics and the risk sentiment, it says here, Iran says Trump's absurd display won't reopen Hormuz, right? So in fact, there was some risk on sentiment coming into the market, I think earlier, that was saying that there was potential negotiations, but this has just happened. But just to kind of give an idea of how bonds kind of react to risk on and risk off and interest rates. It says here European bonds, and it's just bonds in general, win respite as oil drops on Iran hopes. So it says here bonds across Europe surged as oil prices and inflation expectations eased on hopes that the Iran war may end in the coming few weeks, potentially turning the page on a torrid period for global markets. And it says here the latest swings follow comments from Donald Trump, who said he foresaw the war ending within 2 to 3 weeks as the attacks continue. So, in fact, rather than going I'll plan to kind of go through this, right? But I'll see if I can explain this as quickly as I can. 1 second. There was a right. So it says here, while March was driven by a fear of inflation and the negative implications that had on the bond markets, maybe April will be a return to fundamentals where investors start to doubt the amount of rate hikes priced into the market, says Nick Hayes, portfolio manager at BNP Paribas. Right. So with bonds, and I don't really want to get into this too much, right? But you've got bond prices and you've got bond yields, right? And they both move inversely. If bond prices go down, yields go up. And if bond prices go up, yields typically go down. Now, the reasons why we typically tend to focus on bond yields, but if you see an article that talks about bond prices, then it's basically just the inverse, right? It's saying the same thing, but just inversely. Now, bond yields is what the return that you get for buying government debt, and so if bond yields are going higher, right, because there's demand, then yields will typically go to the downside. So why would there be demand for bonds, right, in general? So bond prices going higher, and usually bond prices is seen as a risk off, right? So risk off play, right? Bonds, especially treasuries, gilts from G8, G10 countries are seen as basically very safe, right? And so in a risk-off environment, you typically tend to get demand, right? Demand for government bonds. But again, it depends, of course, AND, sorry, right? But it depends on the risk-off scenario. So the risk-off scenario that they're talking about is not really about inflation anymore. It's really about recession, right? So bond traders want protection against, or bond buyers want protection against potential recession, and they want to lock in actually some yield, today, right? Because if we go into a recession and bond yields start to fall, which they will, then of course, if you buy today at maybe 4%, you lock that in for the next couple of years, 2 years, then of course that looks really attractive, right? But ultimately, basically what he's saying is that the market is really not really necessarily concerned about inflation so much, but more about recession. And normally when the markets are concerned about rising inflation, bond yields will typically rise because there's something called real yields, right? Real yield, right? IELD. And real yield is basically, the bond yield or an interest rate minus inflation. Yeah. And so typically what you should have is positive yield. So you really want the return that you get for holding bonds to be higher than inflation. Otherwise, if it's not, and it's negative real yield where inflation is higher than the return that you're getting on your bond or interest rate, then of course that's not attractive, right, to bond traders. And so what will happen is that that could end up being bad for government bonds, and people don't necessarily want to buy it. And so, because what's the point in holding a negative yielding asset, right? They're going to go elsewhere. So yields have to be attractive to get traders to buy bonds, which creates the demand. So yeah, hopefully you understood that. If not, don't worry, it will make sense as you go through it. But the overall point in all this is just to understand that bonds and bond yields are definitely a key thing to watch when looking at currencies. And normally they're the smartest, traders. They're very sensitive to interest rates, inflation, GDP, risk. Therefore, they typically tend to, bond traders will lead. Actually, they'll be they're a leading indicator of what may happen to a currency. And the same thing as well, you'll see here on bonds, US bonds, right? So we were talking about European bonds, same thing. It says European bonds win on respite. Yeah. And then the same thing as well here, US bonds gain as Israel withdraw. So you can start to now read these headlines and start to, say, okay, well, I know exactly what's happening or what could potentially happen, of course, because as we've just seen, nothing is guaranteed. We could have 1 minute, there could be a de-escalation. The next minute, we could have a re-escalation, right? So that's basically it with that. So where are we at the moment? I still think we're in this risk-off environment until we really head back towards this 20, or unless there's a headline that says that Iran and the US have made peace, or there's negotiations going on credible. Then of course I think risk will probably end up remaining off more than on. And if it does, then of course you can look to buy certain currencies, continue to look to buy certain currencies, maybe like the US dollar, like the Swiss franc, and maybe start to potentially be the yen for now, right? And again, there's other currencies that aren't necessarily acting like typical risk-off currencies like the Australian dollar. But again, we'll get into all that a little later. So let's get into, do you know what I forgot to do? I knew there was something I forgot to do. But it doesn't matter anyway. So we'll go into our central bank analysis, right? And this is, by the way, this is a great channel, and this will give you a snapshot really of what is happening in terms of interest rates, but also as well what the market narrative is, etc. Right. So if you want a snapshot of what's going on, go to the central bank channel, and then you can kind of, from there, you can, if you want to get into any kind of, details, then you can go into the, the Australia, the Canadian dollar, the euro channel there. Yeah. So I'll start off with, actually, I'll just go straight to the countries, get into the nitty-gritty of it, right? So we're starting off on the US dollar, and I'm still bullish on the US dollar, although it's going to be a little tricky when it comes to headlines, right? And escalation or de-escalation of the Middle East conflict. Simply put, if the more the war carries on, it should be bullish for the dollar. The de-escalation is going to be bearish, right? That's the long and short of it. The reasons why, it says here that the dollar strengthened further with the DXY hitting its highest level since May last year. The move is driven by rising fears of prolonged energy supply shock and global growth risks. The report suggests Donald Trump may end military operations without opening the Strait of Hormuz, prolonging disruption. This implies persistent supply constraints. And because the US is relatively insulated as a net energy exporter, and this supports dollar growth. And that's another key aspect of this particular, crisis and risk off, is that, it's whether you're an energy importer, right, or whether you're an exporter. Right. The reason why that's important is because if you're an energy importer, you're going to be more affected by inflation, right? Inflation is likely to hurt, your country a lot more if you're not reliant upon energy, because as energy, goes higher in price, that feeds into the inflation data. Things cost more. We feel it at home, right? Our energy costs, our heating bills, gas bills, electric bills are going higher. That therefore means inflation will rise. Therefore, it hurts, energy importing nations a lot more, inflation does, than energy exporters, right? Because they can keep their costs down. So that's another factor as to reasons why, to look to potentially continue to buy the dollar if the crisis continues, right? And yeah, so that's really where we are. And it says here that dollar strength is currently driven by relative growth strength, yeah, versus the rest of the world. A lot of times you'll see, articles talking about, oh, there's the US dollar is contracting, right? Or is growing, or, there's a focus particularly on one country. But what you have to realize and or keep in mind, I should say, is that it's always relative, right? So if you might see an article that might be a bit doom and gloom on a country, but if every other country is worse than that country, then or in a worse position, then actually it's again the dog with the least fleas, right? It's the who's the best of the worst or who's the worst of the best, yeah. So although traders will say things like, oh, this is the coming dollar collapse. And I've been hearing it for the past like 20 years, right? Dollar still hasn't collapsed yet. That narrative has gone, in the bin, the end of the petrodollar, et cetera, et cetera. I'm not saying it won't happen, but, in the way that these doom and gloomers were talking about, that I don't think that's, in sight at the moment. But ultimately, it's just a case of it's always relative. Always keep that in mind. Who's doing, the best, who's doing the worst. And of course, safe haven demand, energy exporter advantage. But the Fed are, patient, slightly dovish. That's what's working against, maybe the dollar less supportive. And of course, UK and Europe a bit more hawkish for now. So hawkish dovish basically means whether they are looking to, hike rates or cut rates. Right, hawkish meaning hike rates. Dovish is really more to do with cutting rates. So for now, it's a mixed picture, but we're looking at the balance of probabilities, right? Probabilities. I'm not going to spell it out right out, but always look at it in terms of probabilities. What is the market really kind of maybe saying in terms of there's always going to be pluses and minuses, right, for a currency. It's going to be difficult sometimes because there is some confusion sometimes where you've got, one thing going for it, you've got two things going against it. The main thing is how many, positives and how many negatives do you have going for it? And this is where I guess, as I was talking earlier with COT and the COT open interest data that I've looked at can maybe give you that extra, confidence to understand, which hedge funds, or I wouldn't say which hedge funds, but the amount of hedge funds that are maybe net long, net short, et cetera, right? So that could also be, and it's going to be a bit of a confluence for traders as well. But ultimately, I'm still long on the dollar just because I can't see the war really ending soon. Although the market is pricing, is attempting to price in a de-escalation. I don't know whether this is just some sort of optimism, or if it's actually something that is going to continue to move higher. Who knows, right? Who does know? This is the reason why we're in trading. There's no certainties in trading, but I don't believe this is going to be a move to reversal over the night. I mean, it could end up hitting these highs, right? Who knows? I've seen stranger things happen, but ultimately, I think for now, I do think that the with the Iranians not really getting what they want in terms of not being attacked again and certain criteria met, I think this may continue on for a little longer still. Anyways, so for me, the dollar is more on the sell side. It says here, overall takeaway, this is a mixed narrative, right? So it says here, there are bullish drivers on the short term, but there are also bearish drivers. And the dollar is currently, strong for the wrong reasons, risk on oil, but not because of monetary policy, right? So monetary policy is definitely more probably on the dovish side, but it's stronger nonetheless. And yeah, so you can have a read of the articles that I've put in the the channel. So that's really the dollar, and then looking at the the index, right? The equally weighted index. Again, if I'm long on the dollar, I'm not looking to buy the dollar at highs. I'm looking to buy the dollar on a pullback into, some sort of demand zone or some sort of support and resistance zone with some confluence as well. The RSI or the aura and the um, support and resistance. Sorry, 1 second. Where is it? Oh, it's up here. Sorry. I was looking for my usual thing here. So we've got support and resistance. So ultimately, what we're looking for is just a pullback, right, with a bit of the RSI, below the 30. And then that now is seen as a bit of a potential buy. I'm not saying it's going to reverse here. It could go higher. But if you're looking to buy the dollar, this ticks the box for buying the dollar, or definitely ticks a box for buying the dollar. Looking at this from a monthly perspective, monthly highs, monthly lows, it is somewhere around that fair value between a high and a low. Right, yeah. Well, she still could drop a little bit further, so it's still on the expensive side. So, yeah, just keep an eye on that as well. We'll be mindful of that because the dollar may not be ready to be a buy just yet, and you've got to make a personal choice whether you want to be a buyer of the dollar when it's expensive. Do you want to be a buyer when it's more fair value or closer to fair value, or of course, on the cheaper side? So just because it's green doesn't mean you should be a buyer. Actually, you should be buying when it's red and selling when it's green. But yeah, that's that. So the dollar for me is on the buy side on a pullback. Working my way up, I'll go to the UK, and the UK at the moment, for me, is again, this is on the sell side. There is the hawkishness of the Bank of England, but we're gonna get to that in a second. It says here that the UK, right? In contrast, the UK is highly vulnerable to energy imports, right? Worsening its terms of trade. Structural issues include declining North Sea. And let me just, actually, no, I'll just leave that there. Fuel prices surging, right? Pound strength has been largely yield driven, not fundamentally supported. Rising global growth fears and potential energy shortages could trigger a reversal in the pound performance. And so, of course, the market has got ahead of itself and looked to price in more hikes, right? Simply because, of course, the UK would be more affected by inflation because it's an energy importer, and that has maybe the market has used that narrative to drive the pound higher. But I believe that there's a lot of stagflation risk, and stagflation is where you have rising inflation and a contracting economy, and I think that the UK is likely to be probably worse hit from that. And it says here as well. It says the key insight is that the pound strength is fragile and likely temporary. So yeah, bearish on the pound. And also as well, here's very interesting. And it says here that Bank of England's Bailey says traders getting ahead of themselves on rate hike bets. So Bank of England Governor Andrew Bailey warned that markets are getting ahead of themselves in pricing multiple hikes. So, he's come out and poured a bit of cold water on on that narrative, right? Therefore, if you're looking at the pound, yeah, and you're thinking, oh, the pound should be a buy because the Bank of England should hike rates, and the Bank of England come out and then they say maybe we're not going to be hiking rates. Right, actually, it's the wrong one. We're not going to be hiking rates as much as you think we are. Then, of course, guess what happens? We should get at least a decent turnaround, right? At some point. Of course, yet the markets have to believe the Bank of England because the markets are what driving prices. But typically what would normally happen is that would, the markets would then kind of get a little jittery and maybe price out what they had priced in hikes, right? So for me, the pound, yes, has made a bit of a move to the upside, but ultimately, I do believe that, prices should end up, falling to some degree. But maybe it's moving up because maybe more risk on sentiment coming into the market. So maybe the dollar obviously selling off makes the pound and the euro move to the upside. But yeah, I think the pound should be more on the sell side for now in a risk off environment. The Swiss franc. So the Swiss franc should really be a buy in a risk off environment. It is, and it does act as a safe haven. It says here that the overall takeaway is that the Swiss is currently policy suppressed rather than fundamentally weak, and it's talking about really the Swiss National Bank intervening, right? Intervention, and the reason why they're intervening is to basically keep the Swiss franc from appreciating even more. So what happens is that because of the safe haven demand, the currency appreciates. But at the same time, as the currency appreciates, you have something called deflation. F-L-A-T-I-O-N, right? Deflation. So central banks want inflation to be at 2% target, right? They have a 2% inflation mandate. Anything that drives below that, right, which basically is what the Swiss National Bank have in terms of their inflation, I think is like 0.1 or 0.2%. What that really means is that, suffering from deflation, and they want actually inflation to go back up to their 2% target. So they actually need the currency to weaken, right? Because really, what is inflation? As inflation rises and as it's devaluation of a currency, right? So they need the currency to get their current inflation from 0.1%. Yeah. Deflation actually is appreciation of currency. Right, appreciation. When you see deflation, it means that the currency is appreciating, and when you see inflation, actually the currency is devaluing. So, in order to get inflation back up to their 2% target, they actually need the Swiss franc to get weaker and devalue. Yeah. So, where it talks about policies suppressed, what it's talking about is that an intervention, the Swiss National Bank potentially intervening in the market to push the market down, to push the Swiss franc, lower in terms of its value. And so it's not necessarily fundamentally weak. It's just policy suppressed. The policy of the central bank is to keep the appreciation of the Swiss franc in check. They don't want it to go higher. Yeah. So ultimately, that's what they're looking for, right? Is a cheaper Swiss franc. So they're actively making sure that the Swiss franc maybe goes, is capped. Basically, any upside is capped, and it's the opposite actually for the Japanese yen. But we'll talk about the Japanese yen when we get to it. So in a risk-off environment, I think the Swiss franc should be a bit more of a buy. Again, on pullbacks. So the Swiss franc at the moment is on the expensive side when we're looking at it. Actually, no, it's on the cheap side. Sorry. There was an opportunity to buy the Swiss franc right here. So pullback there was a buy back in the 19th, 20th of March. And now it's really a kind of a buy again as we come back down to this zone. So if you think that risk off is going to, increase, then of course it should be a buyer of the Swiss franc. If you think that risk on is going to come into the market, then in fact we could see a bit more of a breakdown on the Swiss franc. But I believe in a risk on environment or in a risk off environment, we should see more upside. Looking at the New Zealand dollar at the moment, the bottom line, it says here, actually the overall takeaway from the New Zealand RBNZ is maintaining a dovish, patient stance, choosing to look through short-term inflation shocks and prioritize growth. It will only tighten policy if inflation becomes persistent and broad-based, not just energy-driven. So, again, from a monetary policy perspective, that's very dovish, right? Quite dovish. So here we go. Bearish near term. And it says here, RBNZ is clearly resisting market pressure, focused on avoiding policy error, tightening into weak growth. And that's the issue, right? That's what stagflation potentially may do, is it may make things a bit worse. But ultimately, it says here that RBNZ is one of the few central banks actively pushing back against hawkish market pricing. Unless inflation spreads beyond energy, policy remains on hold, reinforcing dovish divergence versus other central banks and weighing on the currency. So they're more focused on the economy. They don't want to damage the economy and recovery by hiking, interest rates. And so that's seen as a bit more on the dovish side. So when you look at the New Zealand dollar, I was saying this, that should continue to probably move to the downside. So if anything, you're looking at pullbacks to supply zones before you can look for short trades, I think, as long as that continues, right? By the way, again, this is all driven by what happens in the Middle East. If, all bets are off the table, if, of course, there's an agreement and risk on, comes into the market, but more risk off. Any pullbacks, I think, should be shorting opportunities on the New Zealand dollar. Japanese yen. So the Japanese yen typically does act as a safe haven historically, but I think over the last few years, it really hasn't acted as a safe haven at all, for various reasons. One being quite a low interest rate and acting as a carry trade currency. But we're starting to get a little bit of potential hawkishness coming into the market. It says here, Japanese officials are escalating verbal intervention, signaling readiness for bold action if the yen weakness persists. So it's opposite to the Swiss franc. Before, remember, I spoke about the Swiss franc, and they're trying to cap the Swiss franc from moving higher, right? So the SMB are going to step in here, to try and move it to the downside. Intervention from the Japanese yen is doing the opposite, right? As prices get weaker and weaker, what it's doing is driving inflation way past their 2% target. So 2%, as you know, should be their target. And as the currency is devalued, it's pushing inflation, or it should push inflation higher, right? Whether it does it in the short term or the medium term or the long term, who knows? But ultimately, that's what should be the path for these resistance, right? And so what the central bank doesn't want, is this weakness to push inflation above their 2% target. So what they're doing is they are getting involved here, right? And looking to intervene to push their prices higher, right? Appreciate the currency to try to bring inflation back down to this 2%. Right. So that's really what's happening. Overall, it says here that intervention risk is very high, hawkish shift from Bank of Japan expectations, and currency and energy driven inflation pressure, right? So that's basically it. Policy is that they've got a hawkish shift. Now, the problem is that they also, the only constraint is that they got severe growth deterioration. So, it's basically a double-edged sword where, if you're going to tackle one thing, you're going to basically affect another, which is going to be the economy. So if they start to hike rates to try to fight inflation, right, try and get inflation down, what will typically tend to happen is that the GDP, right, will tend to contract because they're raising borrowing and lending costs to fight, not to fight, but when they raise rates, they're raising borrowing and lending costs, right? And so that in turn hurts consumers and businesses because mortgages are affected. Businesses want to expand, but they want better terms on their loans, right? And so who's going to want to take out a loan or take out much money and invest when interest rates are going higher, when they have to pay back a lot more on interest payments? So it's a double-edged sword, right? So that's the reason why you've got the potential severe growth deterioration. So on the plus side, they're hawkish, right? But on the negative side, of course, you've got growth deterioration. That depends on which side you think the market is going to be on. And I still think that the yen is probably more on the bearish side for now. Again, there's various reasons for that, especially when it comes to things like real interest rates, right? So if you go to the fundamental analysis spreadsheet, we've got real interest rates, right? Real interest rates are right here. And what real interest rates are basically is the interest rate minus inflation. So at the moment, you've got, let's say, for example, Japan their interest rate is 0.75%, but their inflation is 1.3%. So their real interest rate is actually the negative, right? So if you're holding Japanese yen, right, and at an interest rate of 0.75%, in real terms, because inflation is eroding the purchasing power and devaluing your currency, even though interest rates are trying to give you a return on that, actually it's negative, right? Real interest rates is negative. So that for me is quite a Narayan, it's what the banks really, because we don't borrow at bank rates, do we? You know what I mean? The banks are always going to charge a little extra, right? But it's interest rates, and every bank's going to charge their own interest rate. But this is from the bank, right? This is from the bank. So again, what banks can borrow from each other, maybe with a little bit of interest, who knows? But ultimately, this is what these are the central bank rates. But ultimately, if you're an investor that can borrow, that's holding yen and getting 0.75%, and the inflation is 1.3%, you're in negative yield, and that's not attractive. That's not an attractive investment, right? So for me, that I think is one of the bigger problems for the yen. Now, of course, with the central bank looking to hike rates, potentially, of course, that's gonna cause more of a positive impact on real rates. That's if they do, yeah. But if inflation starts to get out, if inflation rises more than interest rates, then you're going to remain in that negative interest rate, right? So, yeah, there's a problem there. There's definitely a problem there, and I think that's one of the main reasons, and their economy as well isn't great, right? Look at that, year on year, pretty much number 8, right? 0.1%, and then you've got GDP, though they're quarter on quarter still hovering around that. Actually, they're ranked 3rd, surprisingly, but if they're fragile, right? And just like every other country at the moment is fragile. And you can see really the winners, or the ones furthest away from a recession, is going to be the United States and Australia. And you can see here that the Japanese yen basically just come out of negative growth, right? So the previous position right here. They've just come out of negative growth to return. Now, if they start to hike rates, as I said before, they could end up hurting growth at the same time as trying to combat, inflation, right? Therefore, right, you could have again a return to negative growth. So it's tricky, and they're very close to negative growth, because negative growth is basically 0% and below 0%. So the closer you are to negative growth, like Canada, which is in negative growth at the moment, is the more you're potentially at the mercy of a technical recession, which is again not seen as positive, right? For a currency, it's seen as more negative. For a currency, we've seen as more bearish. So I think the yen and the Japanese economy is likely to probably struggle with inflation. They're an energy importing nation, therefore I'm going to sell those energy importing nations for now. So that's Japan. Yeah, cumulative rank is just basically um, this is just understanding that it gives it a score, right? So each um, fundamental rank is given a score. So basically, the best versus the worst, right? So GDP is ranked 1 to 8. The highest is number 1. The worst would be number 8, right? So you can see year on year here, Japanese yen, and then it goes through, right? GDP quarter on quarter, real interest rates, etc. Right, and then it gives it a score. So it gives it a cumulative rank, accumulates the score, gives it a score of 33. The lowest score are the stronger economies, and the weaker ones, number 8, would be the weaker ones. But by the way, as well, I'm not going to go through everything here because it's all in the course. Just because something is ranked, number 8 doesn't mean it's going to remain weak, and just because something is number 1 doesn't mean it's going to remain strong. There's something called the currency value cycle, right? And that is in the course. So again, I can't go through everything in this group call. Yeah, it's going to be a long one. It's going to be about 2 hours, but it's all in the course, so it's there for you. So that's the Japanese yen. I think that is more on the sell side. When we look at the Canadian dollar, I think is just it's a tricky one, right? Because you've got fundamentally it's not great, right? It says here mixed to bearish. So macro stagflation risk rising. Bank of Canada not aligned with hawkish market pricing, but oil is supported but not dominant enough. And ultimately, I think it was talking about growth as well. So it says it showed modest growth, yeah, but it says here manufacturing weakened sharply. And the economy entered 2026 on weak footing after the Q4 contraction. And so, yeah, it says here high oil prices is a double-edged sword. It's positive for Canada's energy sector, but negative for consumer spending. So economists warn of rising inflation and higher unemployment, increasing stagflation risk. And the Bank of Canada's holding rates will look through short-term inflation on risk growth. So they're dovish at the same time. So I think, again, positives and negatives. The CAD at first, high oil prices is definitely supportive, but it's usually supportive when, of course, there's growth. If there's no growth, then, of course, it can be seen as a bit of a negative. So I think there are reasons to buy the CAD because of oil. There's reasons to sell the CAD because of the weak fundamentals. And as we see here, again, overall, the CAD is seen as the weakest when we look at everything that we measure. If it wasn't for oil, CAD would definitely be a sell, put it that way. So that's where we are with the Canadian dollar. And have we covered the euro? Oh, I think we might have skipped the euro, sorry. So euro's kind of been benefiting the same way as the pound with regards to the central bank not necessarily being a bit more hawkish, I guess, and the market pricing in more rate hikes. So it says here, markets still expect the European Central Bank to hike 2 to 3 times a year with a possible move as early as April. And really, again, this is more due to the Eurozone being an energy importer rather than an exporter. So again, they're more affected by energy prices in terms of inflation. So it says here, euro inflation jumps sharply to 2.5% year on year in March, the largest rise since 2022. And again, it's energy prices linked to the war. So, overall, it says here, headline, inflation spike forcing ECB towards tightening bias, but core inflation softening, growth weakening creates policy tension, and tightening equals risk recession, and waiting would mean risk inflation persistence. So again, they're in the same boat as pretty much everyone else, right? If the central bank waits, then they're hoping that inflation doesn't get out of control, which they can't afford to be behind the curve. But if they tighten too quickly, then they could move their countries back into or into a recession, which isn't great, right? So again, this is the early stage of a stagflation trade. You're seeing that word stagflation a lot. Every that's the theme at the moment, and that's another reason why I'll probably be a bit more short on the euro and the pound and the yen, because I feel that those three are going to be more in a stagflation trade, or hit by stagflation more than energy importers. Sorry, more than energy exporters. So overall, my bias is to still continue to short the eurozone for now. Although the timing of shorting the euro at the moment hasn't been great, but I am more short than long. And then we've got the Australian dollar. Now, again, typically in a risk-off environment, you would really have the Australian dollar, like the New Zealand dollar, look to fall. But again, every risk off scenario is nuanced. But we did have some news, economic news, which wasn't great for the Australian trade. And it says here, Australian manufacturing slips to contraction on war disruptions. So Australia manufacturing sector returned to contractions driven by weaker domestic demand and falling new orders. Output, employment and purchasing activity all declined, signaling a broader slowdown in the sector. At the same time, input cost inflation surged to 3.5-year high, largely due to, of course, rising fuel and freight costs linked to the Middle East conflict, like everyone else. The data suggests a stagflationary backdrop with weakening growth, but intensifying price pressures, which is inflation. Despite this, strong export demand and higher commodity prices continue to provide some support for the broader economy. So it is now starting to be a bit mixed for the Australian dollar. Growth weakness is negative, but rising inflation keeps the Reserve Bank of Australia on a tightening path, limiting downside. So, I think if you're looking around at, which economies are worse than than Australia, again, there's not many, or if at all. So Australia still have a little bit of a buffer before they even start to get down to, negative growth, right? So I think they can probably still afford to potentially hike and be okay. Whereas you see like the euro area, they're closer to zero, closer to that negative growth. And so it's more difficult for them, to kind of hike aggressively, because again, if it hikes then have that negative effect, which they likely will, and then they go into a contraction. And remember, hiking now doesn't necessarily mean that inflation will come down, right? Sometimes hiking, if you hike rates, it could take months, for inflation to come down. And nobody knows really kind of like what's known as, I think, the terminal rate for inflation, or for interest rates to get inflation to the downside, right? So, I think, yes, it doesn't sound great, but as I said at the beginning of the video, everything in context or relative to each other, right? Doesn't sound great. You might read that in isolation and say, well, the Australian dollar is now a sell. Okay, cool. What would you set it against? What's better than the Australian dollar? That's the key. So for me, the Australian dollar is still maybe more on the buy side. And if their central bank was dovish, then I would probably look for a sell. But because they're still hawkish as well, and their economy at the moment does seem to be holding up a bit better than others, I'm going to look for the Australian dollar to still remain on the buy side, although not necessarily the strongest buy. So looking at, by the way, as well, this was just for the UK. Another reason why I feel that the UK is going to be a sell. It says here why young people can't find a job in London anymore, right? And not necessarily go over it, but you can see youth unemployment. The last time it was this high was really around the aftermath of the 2008, crash collapse, right? and you're seeing, in fact, the UK, well, let's say London anyway, youth unemployment has risen fastest in London. Overall, UK average is still around 15%, but London being the hub, being the capital, that doesn't bode well, for for the economy, right? And so it's to say graduate jobs are vanishing from London as well. Crazy. So so ultimately, I think that's definitely going to be a component going forward if the government doesn't get its act together, and it's going to take a lot to kind of turn around. Anyways, so looking at the pairs. All right, let's look at the pairs. And so I look at these pairs, and to derive what I'm in terms of me being long or short, um, it's really about my fundamental bias, right? So here you've got, and this is the fundamental analysis spreadsheet. You've got three tabs: row guide, risk on, risk off guide. You've got the economic data, which we kind of looked at partially, and then we've got the pairs, right? So you click on the pairs tab. And the pairs tab is just my bias as to whether I'm long or short based on fundamentals, right? And so for me, it's either, strong long, strong short, maybe a week long, week short. Week long, week short would mean maybe just reduce your position size, or maybe, maybe have less positions on that trade. And then neutral bias, no bias. So not decided whether to go long or short, can't really determine the direction on the pair, or I'm not going to determine. There's better pairs out there, because remember, what we're looking for is the strongest divergences, right? We want the strong versus the weak, right? We don't want currencies that are competing with each other, really. Kilua says in this section of pairs in the FA spreadsheet, is it like updated weekly regarding? Yeah, so I will typically tend to update it maybe twice, three times a week, or when it needs it. Now, that doesn't mean that one day or 1 week we're just going to these are all going to change on a week to week basis. What you'll find, and Robin can attest to this, is that once we have a fundamental bias, the fundamental bias can last for a very long time, and typically does, right? So it's not going to go from 1 week going, you're going to go long, and then in another week, you're going to go short on a currency pair, and then you're going to turn it to go long again, right? When we have our biases, normally they would last for weeks, if not months. I've had a bias on pairs for nearly a year, or over a year, matter of fact. So so these biases don't necessarily change, but whenever I'm creating a video, like for example a midweek video, this live group call, or a weekend analysis video, I basically go over my biases, right? So don't worry, you'll be fine. You'll know what I'm long and short on, right? You won't get left behind. So just to kind of go over the pairs, so or the currencies, and what I'm long on and what I'm short on. Oh, you're welcome. You're welcome. So I said dollar, I'm still gonna get long, right? And the Australian dollar, I'm still gonna remain long, right? And we've been long. I've been long on the Australian dollar for probably since maybe like November last year. It's been, was it April now? April the 1st. So it's been about 5 months I've been long on that Australian dollar, right? And for anyone who, I guess now I won't be going into it, but you can kind of see that if you go to the you look at the Australian dollar, right? Yeah, I've been probably long since around here, November, December times, and you can see what's pretty much happened. By the way, if you do want to go back, and look at my past and previous videos, they are all in the trading videos channel. So I'm not chatting nonsense, right? trading videos. In fact, again, Robin will attest. Robin, just tell everyone how long we've been long on the if you're there, how long we've been long on the Australian dollar. But yeah, you can basically go to the trading channels trading videos channel, and then you can always go back and look at my previous videos and what I've said. So it's all there. Yeah, Robin says for about 5-6 months long on the Australian dollar. Absolutely. Right. So, I haven't wavered. It's just literally been, but been very shallow pullbacks. That's the only problem, right? That was our only problem. But we got the direction right. That we've just been long on this, but now we've got a deeper pullback. That's an opportunity to potentially look to buy. But if you can get the direction right, then of course it just comes down to your technical strategy and how you can kind of get into that, right? But yeah, just to show you guys. Anyways, back to the spreadsheet. So long dollar, long Aussie dollar. Think and the Swiss franc, you could look for reasons to buy in a risk off environment. In a risk on environment, of course, it's going to be a sell. I think in a risk off environment, in a risk on environment, the dollar is going to be a sell. And I think that the Australian dollar, whether we're in a risk on or risk off environment, is going to be a buy. I think it's just a winner overall. The next is probably going to be the New Zealand dollar, the Canadian dollar, the Japanese yen. I think probably the Japanese yen might be somewhere around here because there are reasons to buy it, but again, I think I'm probably a bit more bearish. You can look for buys and sells. Actually, you can look for buys and sells on the on the yen because of that intervention risk as well. I think you can look for buys and you can look for sells. The New Zealand dollar, actually, I think the New Zealand dollar, when I think about it, is definitely on the sell side. Sorry, I'll put that down here. It's on the sell side, along with the euro and the pound. I'm still leaning towards selling the yen, leaning towards that. But I understand if you did want to be a buyer of the yen as it gets weaker to try and catch the intervention, the move to the downside, or I say downside, it should really be moved to the upside. I'm thinking about the dollar yen. Then I can understand why you would want to be a buyer of the yen to try and catch that weakness. But ultimately, these are the pair or the currencies that I'd be kind of more short on: New Zealand dollar, euro, and the pound. So with all that being said, it's easier now to then just go through the pairs to look for which ones are the biggest buys and the biggest sells, right? The strongest buy, strongest sells. So for me, the dollar and the US dollar and the Australian dollar are really the only major buys. And then you've got maybe the Swiss franc in a risk-off environment. So I'm going to skip the New Zealand yen, going to skip the euro New Zealand, going to skip the pound New Zealand. New Zealand Swiss, again, you can look for a short, right, on that in a risk-off environment. So looking at the daily first, always look at the daily.